Hey guys, it's Waylon here from Easy Equities. Thank you so much for taking time to come and learn more about the Stanlib ETF offerings. I've got Viermeyer Ferreira here from Stanlib who will be talking us through the products that is available on IPO and has also launched. Two of them is available on the platform already. The other three is still in IPO. Yes, VMO, thank you so much for joining us for this webinar. I'm sure that you will educate our Easy community around your ETFs, and we're looking forward to it.
Thanks, Waylon. Thanks for having me, guys. I'm going to take you through, as Waylon positioned, I'm going to take you through products we are bringing to the market over the next 2 weeks, and they are all international products. And we're quite excited because we think there's value in them. We think they are representative of most or the broad-based asset classes globally. So if you think about constructing a portfolio on a balanced basis, these products can definitely be used to do that. So let's jump into that. This first slide just shows you the products that Stanlib has got. Stanlib Index Investment is the passive product provider within Stanlib, and you can see we've got a range of local products. We now are adding to the global products, and we even have a balanced fund offering. Most of these, where possible, are available within unit trust and ETFs, but I guess for this conversation on Easy Equity, we're only going to deal with the ETF offering. So what are we doing? Let's first go why we think global index funds. And global can be quite daunting. You can, if you go offshore and you go into an offshore platform or online trading platform, you'll see thousands of products, and trawling through them and trying to pick one that works for you is quite difficult. So what we are saying is we are trying to bring a simple, low-cost, transparent global offering to the local market. We are big promoters of diversification. That's cross asset class diversification, it's global diversification. It is anything to do with reducing your risk and not impacting necessarily your return. SA as a percentage of global GDP, as we all know, is quite small. And what we are doing by offering these products are we're offering you more of the world in your local portfolio. We think, and we're going to go into diversification because everybody always talks about diversification, but what we are trying to do in the next slides is we're trying to explain what that actually means. So in this slide, you would see it's the South African market versus the global stock market. So it's the FTSE JSE SWIX index, which is the benchmark for a lot of institutional investors, and it's the MSCI World Index Developed Markets, which is the benchmark index for most global fund managers. And you can see we went back 10 years. So from 2008 to 2017, each bar represents, if it's above the line and it's blue, then it means the South African market outperformed the global market. And if it's below the line, it means the South African market underperformed the global market. And as you can see, in no 3 consecutive years did any one of the two markets outperform each other. And trying to predict which market is going to outperform in which year is quite difficult as well. So if we just go through them, in 2008, South Africa underperformed. 2009-10, we outperformed the global markets. 2011, we under, 12 over, and you get the picture. So this just shows you by either picking one or the other, you're going to have quite a bad year and you're going to have good years. What we're saying is if you start blending them together, you can have a smoother ride. You don't necessarily give up performance in the long time, and you can sleep a bit better at night. The next slide looks quite busy, but what we try to do here is we try to show if you construct an aggressive portfolio, which is just made up of equity, if you constructed a balanced portfolio, which is made up of high equity, and then if you construct a conservative portfolio, which is made of low equity. And we've got a local only version and then a version with global exposure. If we just look at the volatility, which is the line above the blocks, you can see by introducing global on the aggressive portfolio, it takes down your volatility from 17 to 15. So what's volatility? Volatility is how much does my portfolio go up and how much it goes down. So a low volatility means there's a lower up, but there's a lower down as well. So what you get is a smoother ride from an investor point of view. And you can see across the board, even on the balanced and the conservative, by introducing global, you reduce your volatility. Now, normally in financial markets or investments, people will tell you, if you take lower volatility, you need to take lower risk because you need to buy a less risky asset. So let's compare the returns. And the returns you can see is the annualized return. In a aggressive, or let's take the balance for instance. In the balance fund, you get a much lower volatility and you're only giving up 0.3% on performance. On the equity side, on the aggressive side, you're not giving up any performance and you're taking a low volatility. That's all good and well, but how does that, if we try and unitize across the board, the Sharpe ratio is basically a terminology in the investment world to say, for each measurement of risk, how much return am I getting? So a higher Sharpe ratio is better, which means you get more return for the same level of risk. And we all know investments is about the balancing of risk and your return. If we look at the Sharpe ratio, again, let's look at the balance fund. The balance without global and the balance with global, the Sharpe ratio goes up from 45% to 50%. So what it means is for the same level of risk, you're getting a better return by introducing global to your portfolio. So I just think this is a good way of thinking about diversification. Let's quickly go into our offering, broad level. In the middle, let's focus on the gray block. So the gray block shows you which markets we are going to cover or which indices, and I'll go through each of the index and just give you some information on the index. Firstly, we're covering MSCI World. So MSCI World is the global leader at being the benchmark for equity market performance. So that gives you exposure to the biggest companies listed on global indices. It covers all developed world from the Americas, US, Canada, over to UK and Europe, Asia Pac, where you've got the Americas, and then down to Australia. So it covers all the developed markets. S&P 500, I think most people should be familiar with it. It's the benchmark equity index for US investors. So your big US listed companies will be there. And again, we'll look at the names later. FTSE Group of 7 index is quite a mouthful, but it basically means it gives you exposure to global government bonds that are issued by the 7 biggest countries in the world. And we'll also touch further on that. In South Africa, we've got quite a developed property market. And I think the appeal of a property market normally is that you get a good yield from that market. So there's a good dividend yield or income stream coming out of an investment. So what we did here is we added a global product. So we are offering you a global retail investment product, which is a global property. And I think an investor looking for a yield or a dividend or income stream, that's quite a good one. And then last is a bit of a niche focus play, which is the S&P 500 Infotech. And Infotech sounds daunting, but it is household names, and we'll touch on the names, but it's Facebook, Apple, Amazon, IBM. It's names that everybody knows, and we'll see how that sector has grown. So why our range? I think we're probably the first product provider in the market to offer you a full product range. So we offer you equity, bonds, and property in a single offering. The structure that we have chosen is a feeder fund structure. So what that basically means is we go and buy one single offshore underlying instrument that gives you exposure. We are buying the iShares product. And if you're familiar with ETFs and global ETFs, you would know that iShares is the biggest global provider of ETFs. So it gives you access to the best tracking capability in the globe. And then lastly, it gives you cost effectiveness. The problem with normally running products is as the assets grow, the costs decrease, but on day one, there's quite a big cost to bear. By going the route of a feeder fund or going into iShares, we are actually accessing the scale from day one. So as an investor, and we'll get to cost at the end, because cost is obviously an overarching factor in going into passive, we think our cost experience from a client perspective will be a good one. You should be able to reliably see what you're going to pay every day. We did touch on the structure, so I'm just going to skip the slide, and I want to go into the product. And I guess if you are familiar or comfortable with the underlying, you should be comfortable with the ETF. similar, if we are selling you a local product and you're comfortable with the top 40, then you should be comfortable with the product. So that's why we are focusing on the index. So as I said, S&P 500 is the benchmark for US listed equity. So what's the benefit of the US? And I think, again, to the earlier point, diversification. But what does it actually mean? In South Africa, for instance, we have a pharmaceutical sector. But that pharmaceutical sector is made up only of Aspen in all reality. So your sector exposure is to a single company. If you go into the US market, you can see pharmaceutical is a big industry. If we go into healthcare, which is where pharmaceuticals reside, in the South African market, the hospital groups are made up of Netcare, Life Healthcare, and Mediclinic. In the US, it's a much broader and deeper market. And the obvious one that we are missing in South Africa is Infotech, which we've got a separate product on and we touch a bit later. But you can see Infotech makes up between 20 and 23% of the US market. So you're not only getting exposure to the US in terms of macro, which everybody talks about dollar and the US strength, but you're also getting diversification across sectors. You're adding sectors to your portfolio that didn't exist previously if you only had a SA-only portfolio. On the right-hand side, similar to the chart we showed earlier, if we look at the over the last 10 years, the performance of the US market, and this is all converted into rand, so we are looking at like for like. You can see the S&P 500 outperform the JSE All Share Index. By this, we are not saying put all your money in the S&P 500. What we are saying is the S&P 500 can add a good diversifier to your portfolio. It can give you a more balanced outcome and probably give you more surety on your return. If we quickly look at the companies on the S&P 500, and we can run through them, and I think they all should be household names: Apple, Microsoft, Amazon, Facebook, Johnson & Johnson, Berkshire Hathaway, which is Warren Buffett's company, JP Morgan, ExxonMobil, Alphabet, which is just Google's companies. Those are all household names. So you're buying global, but you're not buying into a foreign concept. These are global mega companies that we all know. If we go into the Infotech, and this is an interesting plan. I think a lot of people are quite excited about this out there. Infotech is where you'll see most of your newer companies, global companies. They are companies that are either the old IBM or Dell, which are your computer brands, or the newest software, server, social media type companies. If we just run through the names and the logos, you see PayPal, Apple, Google, Microsoft, Facebook, MasterCard. Everybody uses MasterCard or Visa every day. This resides in that portfolio. Intel, which is the processor to most laptops that people use around the world. Adobe, which is PDF. Everybody looks at a PDF on every basis. So these are household names. They're in a tech sector. Normally, I think normally tech people see red lights because they think it's a fad or it's the new app that's going to explode. But these are new companies. They're excited companies, but they are credible, long-term, consumer-driven companies that everybody knows. And you go into Infotech and you say, maybe I'm exposed to just one thing. Within Infotech, there's quite a big subsector. So you see the top sector and the names of each sector is quite squashed. But if you look at the bars, there's internet and software. There's technology and hardware. There's system software. These all sound like difficult names, but if you just think about them, one is your computer, one is the internet that's communicating to computer, one is your Internet Explorer, one is the PDF document that you're writing. So all of them perform a different function within the value chain of you using tech in South Africa and globally. But these are companies that we are familiar with. If we quickly run through the top 10, again, Apple, Microsoft, Facebook, Google. So Alphabet is just the listed name for Google. You've got Intel, Visa, Cisco, which are major server providers, Oracle, MasterCard. And as I said at the beginning, this is a fast-growing sector or industry globally, and the US is leading the charge. What we did with the chart on the right, we just tried to show the performance versus the S&P 500. You can see it massively outperformed the S&P 500. And as we said earlier, normally people think outperformance or higher performance gives you more risk. But if you look at those two lines, they're very parallel in how they move. So it's not like the one fluctuates up or down and a company goes bust and the new one comes into the market. This is a matured sector in the US, which, given where the globe is going in terms of tech and the use thereof, we see sustainability in this offering. So let's go into the next one, MSCI World. I think MSCI World, especially in a conservative portfolio, if you don't have a particularly strong view, is probably going to be a cornerstone of most people's portfolios, because this is the gorilla in terms of global equity. You get the same exposure as the US, but then you add on Europe, UK, Asian developed, Canada, Australia. So just add to that diversification that we spoke about earlier. And there's the country chart. You can see US, Japan, UK, France, Germany, and others. It is 1,600 companies in 23 developed markets. So your risk, and I think risk is important, your risk is spread across a lot of companies, a lot of countries. So the risk in this portfolio is a lot lower than you going to try and pick one or two stocks globally or buying a very niche or specific fund. If we go into the sector, and again, the same sector benefits for the MSCI World than what we mentioned in the S&P 500. You've got no sector dominating the index. It's deep in terms of the companies that make up that sector. This, for me, should be the default if you don't know what to buy. If you ask me, and this is my personal opinion, if you ask me how should an equity portfolio for South African look, I would say probably 70% South African equity, 30% MSCI World as a default. If you buy all share for 70%, MSCI World for 30%, you can leave that portfolio and you shouldn't have sleepless nights, as I said earlier. The performance, as you see, and this is in a line graph, the same chart as I showed earlier in a bar chart. You can see some years the SA market outperforms the global market, other years the global market outperforms the SA market. It's just prudent to add this to your local portfolio, as you'll get a smoother ride, a more constant risk and return profile, and less concentration in your portfolio. Global government bonds. Global government bonds is an interesting one because most people would have heard yields globally is low, and what they mean there is just government bonds doesn't pay a lot. If you look at South Africa, and people normally refer to the 10-year bond yield, the 10-year bond yield yields between 8 and 9%. So if you take South African inflation as 6%, it normally returns between 2 and 3% over inflation. So you've got a real return of 2.2 to 3%. Global government bonds, in all honesty, yields a lot lower because inflation globally is a lot lower. You'll probably get 2 to 3%. But what this does, it gives you quite a good exposure in terms of currency. The volatility, and again, volatility refers to risk, it refers to how this thing fluctuates, is quite low. So you are basically buying dollar exposure, euro exposure, sterling exposure when you buy into this. So let's just quickly look what it's made up of. So it's made up, again, similar to MSCI World. It's got a good representation of the global economy. It's US, Japan, France, Italy, Germany, UK, Canada. Those are the G7 countries. It is 85% of global bonds, so it dominates. And let's just quickly look at the graph. So you can see, similar to the MSCI World, the line graph on the right, you'll see there's times that the global government bond outperforms. And that outperformance, because this is converted into Rand, you can see when the gray line spiked in 2015, what coincided when we had the whole Nene Gate in December, and you can see the benefit you get for the currency depreciation. When our currency came back, you can see it came down, and that last gray block going down, or line, is just the last month where we had currency strengthening in South Africa, the whole Cyril Ramaphosa positive effect. So this is, yes, it's a global bond play, but I think this is a very strong currency play for a South African investor to get. The left-hand side is just the government bonds that you've got exposure to. The one thing to mention here, you can look at the expiry date or maturity. You can see these are all 2024, 2025 bonds. So these are longer term bonds that the governments are issuing. And the last one is the REIT. We touched on it earlier. A REIT is basically a property company that pays out a certain percentage of its income. And a property company gets income through rental. So a property company rents out, let's use an example, rents out Sandton City, and all the tenants pay them the rent. They take the rent, they pay the expenses, and they pay the shareholders the rent back. And that's what the REIT is. So this gives you broad exposure to global real estate. In South Africa, when we talk property, we normally talk retail property, we talk offices, and we talk industrial property. If you talk global property, and the next slide will show it, and let's actually go there. You can see they've got things. If you look at the top 10 holdings, there's retail, industry, and there's self-storage. We've seen storage pop in South Africa where people can just dump their stuff when they go travel offshore and they come back and they get their stuff. Storage is big globally. It's diversified. Residential, we don't really have residential listed companies in South Africa. They've got residential. So it gives you a very broad exposure to global property. And again, let's look at the line chart. You can see, similar to the bond fund, currency, given the low yield, it plays a big part. And property in South Africa has been a strong asset class over the last 10 years. We all know it. And this global property fund outperformed them. Again, we're not saying it's going to be the same in the future. But adding this to your local property portfolio, again, just gives you a smoother ride, gives you more diversification. And I think that's for us, the main message is, how do you create the best portfolio for the level of risk you want to take? And we think it is through adding offshore to your local portfolio. I guess the next important thing is, how do we think about fees? We think it is important to keep fees constant for clients. Sometimes, and as I said earlier, you either get product providers that come in and subsidize fees at the beginning. So optically it looks cheap, and then as the fund matures, they stop subsidizing, it becomes expensive. Or alternatively, they don't subsidize, and there's a lot of fixed fees within the product in day one. So the effective fee becomes expensive, and then it becomes cheaper. We don't believe in offering the client a fee experience that varies. We want to keep the fee experience constant throughout the life of your investment. And that's why we have gone and fixed our fees at 17.5 basis points, excluding VAT. So on day one, and hopefully on year 5, you should still see 17.5 basis points within your funds. What we also want to show, and what's important here, is the 17.5 basis points, or 0.157%, is what we're going to charge. Obviously, the underlying funds that we are buying into has got a fee component, and that's the line at the bottom we show. So as an investor, you are going to buy the S&P 500 Index Feeder ETF, the Stanlib one, and you're going to pay 27 basis points, including VAT. That's your TER. That's your all-in fee. Yes, there's going to be a fee for brokerage, but from a product provider fee, you should only see 27.5 basis points. And that's the same. MSCI World, as we said earlier, if you think about it, you're buying 1,600 shares across the globe. And in South Africa, you can buy it in a single investment for 40 basis points, including VAT. And we think it's a compelling proposition. We think global, no matter how you do it, should form part of your portfolio. And we're excited because we think South Africa is opening up to the world, and it's just for the benefit of investors.
Great. Ömer, thank you very much. So we'll take a couple of questions. If you've got any questions, you will see that there is a question bar that you can utilize. You can fire away, start asking questions. If you came in a bit later and you missed the webinar, we will send this webinar out to everyone as well, with the contact details for Ömer and myself. If you've got questions, please feel free to give us a shout. If you do have any questions, now is the time to ask them. The 3 of them is available on IPO at the moment.
Yeah, so the S&P 500 and the S&P Infotech is listing on Wednesday, the 7th of March. And then the other three, correct. MSCI World, Global Property and Global Bonds, they are currently open for subscription in our IPO period.
Yep. So you can find those in our new listings site under the main menu. So you can just go and have a look there. You can go and subscribe for whatever amount you'd like to. There's no minimums, as you know. Rema, do you maybe know what the pricing will be sort of for the ETFs at the moment? What is your feeling for pricing of the ETF?
Yeah, we again, in the pricing, we want to make it as transparent as possible. So as an investor, we want you to be able to see the price on a constant basis and be able to have comfort that the price you are seeing is the correct price. So we are applying a ratio to the offshore listed product. So we will be 1/20th of the price. Okay. And depending on where the offshore one trades, the effective rand price comes out anywhere between 30 and 150 rand for a single unit. But the great thing about the ETF is whatever the market is pricing, so whatever global markets are going should be reflective in your price.
Okay, cool. 100%. Guys, I see there is no questions, which means you did your job really well. Thank you very much, Vermeer and Stanlib, for coming to chat to us about these ETFs. We really do appreciate it. Neil Naidu. Neil Naidu is asking what's the benefit of doing the IPO. So Neil, on that side, we don't charge you any brokerage on the IPO. So cost saving, more moolah going towards your ETF.
Yeah, I think that's for us as well. It's offering the opportunity to an investor to come into the product without any additional fees.
Yeah. So that's the main benefit. So the S&P is listing. The IPO is already closed. So once you do buy the S&P on the 7th and it's available on the platform, you will unfortunately have to go through the normal process of paying the 25 basis points when you transact. Great, guys. If you do have any other questions, like I said, I will be sending you all an email. Please feel free to get in touch with me. This will also be available on our YouTube channel. If you missed anything, go and have a look there. I will send you all the link. Have a great day. Thank you for joining us.
Cheers. Thanks, guys.